Hi, and thank you for watching us here at Tax Talk UK, where we talk about all things tax and consider other important aspects of working for yourself, being self-employed, running a small business. So today we're going to talk about what happens if your payments on account for your self-assessment income tax are higher than you expect. Before I do that, if I could please ask, if you're new here, please do take a moment to subscribe to our YouTube channel. That way you'll easily be able to refer back to this information if you should need to, as well as being able to access other information on a whole host of different topics, all aimed at supporting you in your self-employment. If you navigate to the playlist section of our YouTube channel, you'll find the information loosely catalogued, and this should help you to find the information that is most relevant to you. So back then to payments on account. So we talk in other videos in more depth about the payment on account system. And this, you will remember, is for those paying their income tax via the self-assessment system. So you'll remember that some of the tax that you're paying is a payment on account for the following tax year, assuming that you meet various thresholds, which, as I say, we have covered that in other videos. I'll pop that to link in. You'll be able to click towards the end of the video if you want more information on the basics of how the payments on account work, and whether you will meet the threshold and whether you will need to pay them. But here we're talking about what if you do meet the thresholds and there's a payment on account calculated as part of your self-assessment tax return, but for some reason in the following year you don't expect the income or the liability to be what has been used to predict this. Now, there's lots of reasons why this may happen. Perhaps you had a peak in profit for 1 year, and that resulted in a higher than usual liability. Perhaps you are you're working in the construction industry and you had an unusually low level of work that was through the CIS scheme, and you now expect that to be higher. Perhaps you're just generally winding down your activities, or perhaps you've stopped trading and your income is now taxed at source. So there's lots of reasons why that payment on account may be predicting to be higher than actually, when it comes to it, will be required. So the first thing to say is that if you don't do anything and you pay the higher payment on account, and then when you submit your self-assessment tax return, it shows the liability is lower than the payments on account, then once the liability, the exact liability, is updated on the account, the payments on account that have been made will result in an overpayment and you will be refunded that. That's no problem. So please don't worry or feel anxious that if you don't do anything that you're going to be paying that tax and you can't recover it. So that's important to note. The other thing to mention is that although there is a process and a system fairly straightforward to be able to notify HMRC that you believe your payments on account are going to be too high and you want to reduce those, the important thing to note is that when your actual tax return goes in, if your actual liability proves to be higher than your amended estimate, then anything between that and the amount that HMRC had estimated, you will pay interest on. So let's think of an example here. So let's say, for example, that your tax liability 1 year is £2,000, and then the payments on account are based on that at £2,000. And so that you're expecting to pay 1,000 in the January and 1,000 in the July based on that prediction of the 2,000. Let's say, for example, that for some reason you're fairly confident that your tax liability is only going to be £1,000 for that year, not 1,000. So therefore, you want to notify HMRC that you're going to make a £500 payment on account in January and July. Let's say, for example, that your tax liability ends up being £1,500 for that year, then actually, in effect, if you retrospectively look at everything, you have underpaid your payments on account by £250 each time. And therefore, that amount from the date, from the January or the July, depending on where we are when you actually submit your return and make those payments, you will incur interest. So there is that to consider. So it can be prudent if you're not sure in that scenario, for example, if you think, well, actually my payments on account are going to be £1,000 each time based on a liability of 2,000. I think it's going to be 1,000, but actually potentially it could be a little bit more, and I think 1,500 would be the maximum. Then it may be wise to reduce your payments on account. And remember that any overpayments will be refunded. So so making an overpayment means that you haven't got the money, but you're not going to be charged any interest if it turns out that your payment was lower than it should have been. So that, of course, is to avoid people deliberately reducing their payments on account too low, and kind of circumventing that whole system in place. So it's important to know that if you do, in effect, if you reduce your payments on account too low, below what the actual liability is, that will incur interest. Another point, if you're genuinely unsure what the level will be, is if you do your tax return. So obviously when the January payment on account is due, then it's too early to be doing your tax return. Although by this point you may have a good idea of what you expect your liability to be, on the basis that we're sort of getting towards the end of the tax year. But then you then have from the 6th of April, May, June and July before the July payment on account is due. So again, in that scenario that I just mentioned, where your payment on account is due to be £2,000 in total, so £1,000 each time, and you think it's going to maybe be 1,000, maybe 1,500 as a maximum, then in that situation, what it would be prudent to do is to pay the £1,000 payment on account in January, therefore making sure that you don't inadvertently incur yourself any interest. Complete your tax return before the July payment on account is due, and therefore, if it then shows that your tax liability is only £1,000, then you've already made that £1,000 in January, and therefore nothing will be due in July. If it showed that your tax liability was £1,500, for example, then you've already paid 1,000. So rather than paying the full £1,000 expected in July, you would only pay the 1,500. And because by that point you would know the actual liability, and so would HMRC. So that only counts if you have submitted your tax return by the end of July. As I say, don't panic if you don't, because any overpayment paid tax will be refunded. So these are the things to bear in mind. These are some ways to sort of manage your payments on account without having to reduce them if you're not certain on what will be needed. But if you are certain, or you're certain that liability is definitely going to be lower than the previous year, then the way to notify HMRC, if you've already submitted your return, you can simply write to them or a phone call. And remember that writing to HMRC can take quite a while for them to process. So a phone call may be better. But if you haven't submitted your tax return, then what you will find is, before you come to submit it, right at the last stage, you will be asked, do you want to reduce your payments on account? So if you select yes, you will say what each of the payments on account will be, and then you will give an explanation of why you believe your liability is going to be lower and why you believe that those payments on account are too high. So you should there give factual and brief, concise information, but the full circumstances, so that somebody at HMRC can look at that explanation and consider, yes, this is a genuine reason. We agree that it's likely that on this information that this taxpayer has provided, their payments on account would be lower, and therefore that they will make the lower payments, and based on that, you will then only be expected to make the lower payments that you've indicated to HMRC. But remember, all you're doing is really revising the estimate of that HMRC's policy, of course, is to base it on the previous year, and yours is still only an estimate. So just remember that if that estimate is too low, you could incur yourself some interest, and the same as if you don't do anything about your payments on account. If your estimate is too high and you end up paying too much tax once your liability is known, then any overpay tax will be refunded. So it's always important to remember that. So it's getting the balance between obviously not, thinking of your cash flow and not paying too high a tax than you need to, but making sure that you don't reduce that too low and inadvertently incur yourself interest costs. So hopefully that helps you to understand a little bit about the options that are available to you if your payments on account are expected to be to result in an overpayment. Both managing your payments on account and how to notify HMRC if you feel that you need to pay lower or no payments on account. Thank you very much for watching, and if you haven't already, please do subscribe to our YouTube channel. Thank you. Goodbye.